If you're 58 years old and you're still sending £1,200 a month to a mortgage lender, most of the retirement advice sitting on the internet right now is talking about someone else's life, not yours. Nearly every version of the 4% rule, every drawdown calculator, every how much do I actually need to retire video starts from one quiet assumption. It assumes your home is paid off. Take that assumption away, and the maths doesn't bend a little. It breaks. Here's the number that makes this real. The average retiree who's still carrying a mortgage into their 60s owes £63,643 on it, and that single debt is currently standing between 16% of people in your age bracket and the retirement date they actually want. Not a comfortable retirement. Any retirement at all. Picture what £1,200 a month actually competes with once the salary stops. That's more than most households pay in council tax and energy combined, and unlike those bills, the mortgage lender gets paid first, every month, out of a pension income that doesn't rise just because the mortgage didn't disappear. So today isn't another generic video about pensions or another generic video about mortgages, treated as if they live in separate worlds. We're working out the actual order of operations between your pension pot and your mortgage balance, because clearing both at the same pace on autopilot is rarely the route that gets you free of either one fastest. If you're in that squeezed middle right now, trying to hit a mortgage finish line and a pension deadline in the same decade, stay with this one. Subscribe while you're here. This channel is for people who want the maths worked out properly, not the version that's easiest to sell. According to the most recent research into over 55 borrowers, roughly 1 in 5 mortgaged homeowners in that age group don't expect to be mortgage-free by the time they retire. And the ones who aren't, on average, carry £63,643 of debt with them into what's supposed to be their golden years. I've watched this play out with people who did everything right on paper. Good job, steady payments, never missed one. The mortgage just outlasted the working life it was supposed to fit inside. There's a belief sitting underneath most of this, and it rarely gets said out loud. It sounds something like, I've always had a mortgage, I'll always have one, it's just what a monthly budget looks like. That belief made sense at 35, when a payslip was arriving every month to cover it. It stops making sense the moment that payslip disappears, and a fixed pension income has to cover the same bill instead. Ask yourself honestly how many years are actually left on that mortgage term, and whether that number lines up with the age you've been picturing for retirement. For a lot of people it doesn't, and nobody ever sat them down to point that out. The scale of this is bigger than most people assume. Research from the Equity Release Council and Canada Life found that mortgage repayments are currently stopping 18% of over 55s from saving more for retirement, and stopping 10% from cutting back their working hours even when they want to. That's not a handful of unlucky cases. That's a structural squeeze happening across the country right now, to people at exactly your stage of life. Multiply that gross-up figure across a full year, and it gets sharper still. A mortgage that quietly cost £12,000 a year in take-home pay terms while you were working can end up needing something closer to £15,000 of gross pension income to service it once you retire, before a single pound goes toward food, energy, or anything else on the list. Here's the mechanism that makes a mortgage more expensive in retirement than it ever was while you were working. A £1,000 monthly mortgage payment isn't really a £1,000 problem once it's coming out of pension income. If that income is taxed at the basic rate, you need roughly £1,250 of gross pension income just to hand the bank its £1,000, because tax takes its share before the mortgage ever sees a penny of it. And the invisible cost here isn't just that gap in any single month. It's every year you spend paying a mortgage and building a pension at full price at the same time, instead of letting one obligation clear early enough to redirect real money at the other. Now, if a pension gives you free money through tax relief on the way in, it's tempting to assume the pension always wins this contest automatically, every time. It doesn't, and the reason why comes down to which tax band you're actually sitting in. Here's where most generic advice falls apart, because it treats pension or mortgage as one question with one answer. It isn't. The right order depends almost entirely on which tax band your income sits in right now, and once you split it that way, the fog clears fast. If you're a higher rate taxpayer, paying 40% tax on your income, the pension wins first, almost every time. Put £100 into your pension, and it only costs you £60 out of your own pocket, because the taxman effectively hands back the other £40 as relief. That's not a return you earn by taking risk. It's a return you get simply for using the right account. No mortgage rate in the country, not even a 6% one, beats an instant 66% gain on the money you put in. Now move to a basic rate taxpayer, paying 20% tax, and the picture shifts. Put £100 into your pension here, and it costs you £80, not £60. That's still a real benefit, but it's a smaller one, and it has to be weighed against what your mortgage rate is actually costing you every year. If your mortgage sits around 5% and your pension is realistically growing at something like 5% a year after fees, the mortgage often wins this contest, especially once you remember that 25% of whatever comes out of that pension later gets taxed as income on the way out. Get this order wrong, and the cost isn't dramatic, it's slow. You end up paying full price for a mortgage and squeezing full pension contributions out of the same income at the same time, for years longer than you needed to, when directing those same pounds in the right sequence could have freed up one obligation early enough to let it help pay off the other. I used to be a pension-only purist about this. I genuinely believed the maths was the only thing that mattered, and that any pound not going into a pension first was a pound wasted. What changed my mind was watching basic rate taxpayers who cleared their mortgage instead. The theoretical gain they gave up in the stock market was small, often less than 1% a year. What they gained back was breathing room in a monthly budget that no spreadsheet fully captures. Let's put a number on that trade-off, because it's easier to trust than a percentage. Overpay your mortgage by £10,000 at a 5.5% rate, and you save roughly £550 a year in interest, guaranteed with no market risk attached to it at all. Put that same £10,000 into a pension as a basic rate taxpayer, and it effectively only cost you £8,000 to do it, but a slice of whatever it grows into will be taxed as income when you eventually draw it out. Neither answer is wrong. They're built for different tax bands, and mixing them up is where most people lose money without ever realizing it. This isn't a personal opinion pulled out of thin air. It's the same tax band logic that regulated financial advisors point clients toward when this exact question comes up, because the arithmetic genuinely does flip once you cross the line from basic rate into higher rate territory. Before you move a single pound based on any of this, there's one detail buried in most mortgage contracts that can quietly cancel out everything we've just worked through, and it catches people who've done all the maths correctly. Here's the scenario most retirement calculators never show you, because they assume calm, steady markets every single year. Markets don't behave that way, and the difference matters most in exactly the years you can least afford it. Picture retiring with an £800 a month mortgage still attached to your name. Then the market drops 20%, the way it did in 2008, and again in 2022. You don't get to wait that out quietly. The bank still wants its £800 next month, so you're forced to sell shares at a loss to cover it, locking in the damage at the worst possible moment instead of giving your portfolio time to recover. Run the actual numbers on that forced sale. A £100,000 portfolio that drops 20% is suddenly worth £80,000, and pulling £800 a month out of it while it's down locks in a real loss that a mortgage-free retiree simply never has to take, because they still have the choice to wait. Now picture the same market drop, but you're mortgage-free. Your fixed monthly floor, the council tax, the energy bill, the essentials, might come to something like £300 a month. When markets fall, you can tighten your belt, cut back on optional spending, and simply wait for a recovery, because nothing is forcing your hand to sell anything at all. That gap between those two positions isn't really about investing skill. It's about how much of your monthly outgoings are fixed and unavoidable versus flexible and postponable, and a mortgage sits firmly in the fixed and unavoidable column every single month for as long as it exists. There's a second pressure stacking on top of this one, and it's arriving for a lot of people right now. The state pension age is in the middle of moving from 66 to 67, phasing in from April 2026 onward. If you can't draw your state pension until 67 and your mortgage is still running past your last day of work, you're funding that entire gap privately, out of your own pension pot, at exactly the age you'd planned to finally stop relying on it so heavily. So the question isn't really whether clearing the mortgage helps. It clearly does. The real question is how to actually do it without walking straight into the penalties. Most fixed-rate deals are built to charge you for moving too fast, and without giving up money you didn't need to give up along the way. So here's the sequence, in the order it actually pays off, not the order most people stumble into by accident. Step 1. Never skip the employer match on your pension, no matter how tempting it is to redirect that money at the mortgage instead. If your employer adds money the moment you contribute, that's an instant 100% return before a single pound has even been invested. No mortgage overpayment competes with that, so this piece always comes first, regardless of your tax band. Step 2. Find your 10% rule. Most fixed-rate mortgage deals in the country let you overpay up to 10% of the outstanding balance each year without triggering an early repayment charge. Check your mortgage statement or call your lender and get that exact figure today, in pounds, not as a vague percentage, so you know precisely how much you can safely direct at the balance this year. Step 3. Use the short-term surge. Once your mortgage has fewer than 5 years left on it, extra payments start clearing the balance faster than the interest can rebuild it, and the effect compounds harder the closer you get to the end. This is where overpaying tends to earn its keep the most, because there's so little time left for compound interest to work against you instead. Step 4. Once the mortgage is actually gone, redirect that entire former payment straight into your ISA or your pension, immediately, not eventually. The single biggest mistake people make here is letting a cleared mortgage quietly get absorbed into everyday spending, instead of continuing to work for their retirement the way it always did. Run that step forward and the cash flow speaks for itself. Redirect a cleared £800 monthly payment into a pension for the final 5 years before you retire, and even before any investment growth is added on top. That's £48,000 landing in your pot from cash flow alone that used to disappear into a mortgage statement every single month. I remember a client who spent years assuming the answer was simply a bigger pension pot. Then one year he did the maths properly and realized his mortgage was costing him more in life hours, actual hours of his working life, than his pension was earning him back in compound interest. He didn't need a bigger pot in the end. He needed a smaller monthly cost, and clearing the mortgage gave him that directly. Now, what happens if you run these numbers honestly and the gap simply doesn't close? What if there isn't enough time or income left to clear it this way at all, no matter how disciplined you are about following each of these 4 steps? All of this works well for a lot of households, but not every household is starting from the same place. So let's stress test it against a harder case. Picture someone in their late 50s, in London or the South East, earning around £50,000 a year, with £150,000 still left on the mortgage. No ordering trick, no overpayment strategy, no amount of clever sequencing clears £150,000 in 7 years on that salary. The maths simply doesn't allow it, and pretending otherwise would be doing you a disservice. In that situation, the honest answer isn't a faster payoff plan. It's a longer runway. That means accepting a retirement date closer to 67, which now lines up with where the state pension age is heading anyway. Protecting the full employer pension match every single year along the way, rather than sacrificing it for overpayments, and then using part of your pension's tax-free lump sum, up to £268,275 under current rules, to clear whatever balance remains the moment you actually retire. That's not a failure of planning. It's planning that matches the size of the number in front of it, instead of pretending a bigger number behaves like a smaller one. A £150,000 mortgage in an expensive part of the country is a genuinely different problem to an £800 a month mortgage somewhere with lower house prices, and it deserves a genuinely different answer, not the same generic advice stretched to fit both. There's a quieter option worth naming honestly too. Downsizing. Selling a larger family home that no longer needs 4 bedrooms and using part of the equity to clear the balance outright. It's not the answer everyone wants to hear, and it doesn't have to be the first option you reach for, but it belongs in the conversation alongside the pension lump sum, not dismissed before it's even considered. This isn't a rare edge case either. It describes a very ordinary story, a family home bought decades ago on a joint income that later became a single income after redundancy, illness, or a divorce nobody planned for, leaving one person holding a mortgage sized for 2 incomes. Which brings us to the question underneath all of this, the one that isn't actually about money at all. None of this has ever really been about finding the mathematically perfect answer. Perfect is a spreadsheet exercise, and spreadsheets don't have to get up and go to work on a Monday morning. The goal was never the biggest possible number sitting in an account somewhere. It was options. It was the ability to choose, rather than being forced, by a monthly payment that doesn't care how tired you are of making it. So instead of asking what's technically optimal, ask a smaller, more useful question. Which debt, once it's actually cleared, lets you hand in your notice next year instead of in 5 years? For a lot of people reading their own numbers honestly, that answer points straight at the mortgage. Not because pensions don't matter, but because a mortgage is the one obligation that follows you around every single month, regardless of what the market's doing that week. There are real changes coming to how this all works, including the cash ISA allowance shrinking from the 6th of April 2027 for savers under 65. If you want to stay ahead of changes like that instead of finding out about them after the fact, subscribe now while it's on your mind. And if you're 58 or 62 or 55 and you're only just working through this sequence now, you're not behind. You haven't missed anything unrecoverable. You're simply refining the order, and the order is exactly what we've spent this video working out together. That's a genuinely different position to be in than never having known there was an order to refine in the first place.